In today's financial landscape, credit scores play a critical role in an individual's economic life. A credit score is a numerical representation of a person's creditworthiness, which is an estimate of the ability to repay debts. It is calculated using a variety of factors, including payment history, amounts owed, length of credit history, types of credit used, and new credit inquiries. This video aims to explore the importance of credit scores, the factors that influence them, their implications for consumers, and the broader economic impact they hold. Credit scores are vital for several reasons. They directly affect an individual's ability to secure loans, obtain credit cards, and even rent housing. Consumers with high credit scores often enjoy lower interest rates from lenders. This can result in significant savings over time, particularly for large loans such as mortgages or auto loans. Lenders view high credit scores as indicative of responsible financial behavior, which can lead to preferential terms. Conversely, a low credit score can result in higher interest rates or, in some cases, outright denial of credit applications. The factors that influence credit scores are essential for consumers to understand in order to manage their credit health effectively. Payment history accounts for approximately 35% of a credit score. Timely payments on loans and credit cards positively affect this aspect, while late payments can severely affect overall scores. Another key factor is the amount owed, which includes the total debt relative to credit limits. Maintaining a low credit utilization ratio, ideally below 30%, can enhance one's score. The length of credit history, constituting 15% of the score, reflects the age of one's credit accounts. A longer credit history is typically favorable, showcasing reliability over time. The types of credit used make up another 10% of the score. A mix of revolving credit, like credit cards, and installment credit, like personal loans, can portray a responsible credit profile. Finally, new credit inquiries account for 10%. Opening multiple new accounts in a short period can indicate riskiness and negatively impact credit scores temporarily. Understanding credit scores extends beyond individual finances. They are integral to the overall economy. High consumer confidence, illustrated by increased spending and investment, often correlates with higher credit scores. When consumers perceive themselves as financially stable, they are more likely to engage in significant purchases, such as homes or vehicles. This spending drives economic growth and can lead to a positive cycle of job creation, as businesses respond to increased demand by hiring more employees. Moreover, credit scores serve as a critical tool for lenders and financial institutions to assess risk. They enable banks to make informed decisions about extending credit. Consequently, these institutions can maintain profitability while also providing necessary funds for consumers and businesses. However, this reliance on credit scores also raises concerns. Individuals with lower scores may find themselves excluded from essential financial products, potentially perpetuating cycles of poverty. Recent developments in consumer rights and financial literacy education aim to address some of these disparities. The introduction of fair credit reporting laws has provided consumers with the right to dispute inaccurate information on their credit reports. Additionally, there has been a push towards promoting transparency regarding how these scores are calculated and used. Programs offering credit education have become increasingly prominent, assisting consumers in understanding their scores and the measures they can take to improve them. Another essential aspect to consider is the future implications of credit scores. As technology evolves, the methods of calculating creditworthiness are likely to become more sophisticated. Innovations such as machine learning and the use of alternative data sources are poised to change how lenders assess risk. Potentially, these advancements could help broaden access to credit for underserved populations by considering additional factors such as rental payment history or utility bills, which have historically played a minimal role in traditional credit scoring models. The advent of fintech companies and alternative lending platforms also signifies a shift in how creditworthiness may be assessed. These entities often utilize non-traditional metrics to evaluate applicants, potentially providing loans to individuals who may not have classic credit histories. However, this shift also raises concerns about consumer protection and the potential for predatory lending practices. Policymakers must ensure that these innovations promote fairness and access without compromising the financial safety of consumers. Responsible credit practices remain paramount for individuals seeking to maintain or improve their credit scores. Regularly monitoring credit reports, disputing inaccuracies, making timely payments, and learning about the repercussions of credit behaviors are all vital strategies. Awareness and education about credit usage can significantly empower consumers. Credit scores enabling them to make informed part of modern financial life, influencing personal finance and broader economic trends. Understanding credit scores, their determinants, and their implications is critical for consumers. As society evolves, the methods for calculating creditworthiness are also likely to change, promoting a more inclusive financial landscape. Nevertheless, individuals must remain vigilant and proactive in managing their credit, thereby ensuring that they can navigate the complexities of borrowing and lending in today's economy successfully. Cultivating financial literacy and access to fair credit opportunities will remain essential in shaping a stable economic future for all. To comprehend the importance of credit scores, one must first understand the factors that contribute to their calculation. Credit scores typically range from 300 to 850, with higher scores indicating better creditworthiness. Primary components influencing these scores include payment history, amounts owed, length of credit history, types of credit used, and new credit inquiries. Payment history, which accounts for approximately 35% of the score, reflects an individual's reliability in repaying debts, while the amounts owed, often referred to as credit utilization, constitute about 30% of the score. A thorough understanding of these components is crucial for individuals seeking to manage their credit effectively. The implications of credit scores extend beyond mere numbers. They significantly impact various aspects of an individual's financial life. For instance, lenders use credit scores to assess the risk of lending money to a potential borrower. A high credit score can result in lower interest rates on loans and credit cards, ultimately saving an individual a substantial amount of money over time. Conversely, a low credit score may lead to higher interest rates, increased fees, or even outright denial of credit applications. This disparity underscores the necessity of maintaining a good credit score, as it can determine one's financial mobility and access to essential resources. Moreover, credit scores play a critical role in non-lending scenarios, influencing decisions in areas such as employment and housing. Many employers conduct credit checks as part of their hiring process, particularly for positions that involve financial responsibilities. A poor credit score may raise concerns about an applicant's reliability and judgment. Similarly, landlords often consider credit scores when evaluating potential tenants, as a strong score may indicate a history of responsible financial behavior. Thus, credit scores extend their influence beyond traditional lending, impacting employment opportunities and housing options. In light of their importance, individuals must adopt proactive strategies to maintain and improve their credit scores. Regularly monitoring one's credit report for errors is an essential first step, as inaccuracies can negatively affect scores. Moreover, individuals should prioritize timely payments on existing debts and strive to keep credit utilization below 30% of their available credit. Establishing a diverse mix of credit types, such as credit cards, installment loans, and mortgages, can also bolster a credit score. By implementing these strategies, individuals can work toward achieving and sustaining a healthy credit score. In conclusion, credit scores serve as a crucial determinant of financial health and opportunities in modern society. Understanding the factors that influence credit scores and their implications on lending, employment, and housing can empower individuals to make informed financial decisions. By actively managing and improving their credit scores, individuals can enhance their financial stability and open doors to a myriad of opportunities. As the financial landscape continues to evolve, the importance of credit scores remains a constant, underscoring the need for financial literacy and responsibility in navigating today's economy. If you found this helpful, don't forget to like, subscribe, and hit the bell so you never miss a money tip. Drop a comment below with your thoughts or questions. I'd love to hear from you. Until next time, stay smart, stay savvy, and keep building your financial future.